This is insane. We have to talk about one of the biggest head-scratchers in finance right now. Think about it. The crypto world finally gets everything it's been asking for from Wall Street, and then the whole thing just collapses. So what in the world happened here? Yeah, that's the big question we're going to unpack. On the surface, none of this makes any sense. This was supposed to be the big one, the moment the rocket finally took off. But instead, it was more like a catastrophic failure to launch. And to really get the scale here, we are not talking about some small dip. We saw a record-breaking liquidation, $19 billion in just 24 hours. But here's the mind-blowing part. 70% of that, nearly $14 billion was gone in just 40 minutes. That's not a sell-off, people. That is a full-blown flash crash. So how do you go from pure euphoria to absolute panic that fast? Well, when we dug into it, it looks like there were three main culprits, three forces that converged to create this perfect storm. We've got ETF outflows, a significant corporate domino, and a huge sudden shift in sentiment. First up, the ETFs. Remember, these were supposed to be the floodgates, opening up crypto to a tidal wave of new money. Well, instead of a flood, it was more like someone pulled the plug on the bathtub. We saw a net outflow of $5 billion from these new spot Bitcoin ETFs. That's huge. And it means the average person who jumped in is now underwater, which, as you can imagine, really spooks new buyers. Culprit number 2, the corporate domino. This one centers on MicroStrategy, the biggest corporate holder of Bitcoin. They posted a staggering unrealized loss of over $17 billion. Why does that matter so much? Well, their whole strategy was to issue stock, take the cash, and buy more Bitcoin. It was a flywheel that kept spinning up the price. Suddenly, that flywheel slammed into reverse, sending a shockwave of doubt through the entire market. And the third piece of the puzzle is a massive shift in sentiment. When fear takes hold in global markets, investors run for safety. They sell off what they see as the riskiest assets. And in that moment of panic, Bitcoin wasn't treated like digital gold, a safe haven. Nope. It was treated like a 24/7 ATM because the market's always open and you can sell it instantly. It became the first place people went to get cash, not the place they went to hide it. Okay, so after that brutal crash, something interesting happened. The price fell and then it hit a wall, bouncing hard right around the $60,000 mark. So now everyone is asking the same thing. Is this price floor made of solid concrete, or is it just sand ready to wash away? You basically have two big schools of thought on this. The first is all about the miners. The thinking goes that it costs about $60,000 to mine one new Bitcoin. So if the price drops below that, miners start losing money, they shut off their machines, and that selling pressure disappears. The second theory is about investor psychology. The idea here is that at 60K, you cross a line where more people are sitting on a loss than a profit. And nobody likes to sell at a loss, so it creates a natural break on more selling. But here's where it gets really interesting. Michael Saylor comes in and basically says you're both missing the point. He calls miners and psychology third-order effects. What really matters now, he says, is Wall Street, the credit, the new financial products, the derivatives. That is what's going to move the price. He thinks that financial layer on top has 10 times the impact of anything the miners could ever do. All of this leads us right to the heart of the debate. The market is balanced on a razor's edge, with Wall Street's influence exploding. So, was that crash the bottom, or is this whole thing just a trap? The bulls on one side see a big drop and just shrug. They say it's a normal bull market retrace, pointing to the 55% drop back in 2021. No big deal. But the bears look at the exact same chart and see a classic bull trap, that false sense of security that sucks people in right before the next big leg down. On the bull side, you have guys like Gary Vee who are buying with both hands. They see a gift, an unexpected second chance to get in before the market takes off again. For them, all the bad news is priced in. This is the bottom. But then you have the bears saying, not so fast. They point to analysts like Mike McGlone from Bloomberg who totally called this retrace. They're convinced this is a classic bull trap, that this pause around $60,000 isn't a bottom, it's just the market catching its breath before the next serious drop. With the bulls and bears in a complete stalemate, the tiebreaker might not come from traders at all. It might come from Washington, D.C. and the huge wildcard of regulation. Right now, all eyes are on one specific piece of legislation, the Clarity for Digital Assets Act. Its goal is to end the chaos and finally create a clear set of rules for the entire crypto industry. Behind the scenes, there's a brutal political tug-of-war. UVA got the White House hosting meetings and pro-crypto super PACs that have raised nearly $200 million to get this passed. But in the other corner, the traditional banking lobby is fighting it tooth and nail, terrified of the competition. This is a genuine coin flip, so a perfect storm caused the crash. Now the market is sitting on a fragile 60K floor with bulls and bears locked in a stalemate. The whole thing might come down to what happens next in Washington. This leaves us with the single biggest question. Will regulation be the catalyst that unlocks crypto's potential, or the final boss it just can't defeat? The ETFs open the door to Wall Street, but the game is far from over. Thanks for watching, and don't forget to subscribe for more updates.